Hey everyone, I'm going to walk you through a new trade that I did with TFS Financial Corporation, and right now it is February 5th, 2013, and it's a little after, that's about 2:50 p.m. right now. To start off, I got into this trade, well, it was a straddle, and the reason why I did this straddle is because of the company having earnings. Now, I was in this trade for less than 24 hours, and I made $215 in profit, and I will walk you through the trade later. But I want to just emphasize on the implied volatility and its reaction to the option price. Implied volatility, as that increases from where you actually purchased the contract at, it could increase because of earnings, which is why I was in this trade, or it can increase due to different types of news events. If there might be a substantial court ruling, that could have a serious impact on the implied volatility. And the reason why this increases the option premium is due to a Greek called Vega. And as implied volatility increases, Vega will increase the price of your premium. And Vega has a certain number that it will increase the premium by the option buy. And this is by every one increment increase in implied volatility, Vega will increase your option contract by a set amount. And in this case, that's what I was really looking for. With a straddle, you want the stock to move a lot as well. But if your implied volatility increases a drastic amount, then the stock doesn't necessarily have to move a good bit in order for you to capture profits. And that's what just happened in this trade. I was only in this trade, again, it was less than 24 hours. And to lay out what I actually had in this trade, I bought the February 13th call at 55 cents, and then again, option contract has 100 shares in it, so you times that by 100, and that gives you $55. And so at risk for the call aspect of it, I had $55, and then I bought one February 13th put at 30 cents. Again, that would be $30 once you times it by the 100. And so total at risk for the trade, I had $85. And what wound up happening was I bought the contract at low implied volatility. It was actually low based on historical data. I wish I could show you that data right now, but I can't find any software that actually shows implied volatility well enough to actually show it to you. But what happened was I bought the contracts, and when I initially bought the contracts, the implied volatility for the call was 39.6. And then for the put, it was 31.9. And what wound up happening was I bought this the day before, and to show you, this is the day that I bought it. It was on the 30th of January for 2013. And then the following day, bam. Apparently they had good positive earnings announcement, and the stock shot up. And I bought the stock, or I'm sorry, I sold out of the position at 9:54 the next trading day. And the reason for that is because the implied volatility shot up to, it was 291 for the call, and it was about 50 for the put. And this increased my call in profit. Now, that, again, this is in profit. It increased my call to $212. That was profit that I got on that. And the put, it only increased a little bit to $3. So total, at risk, I only had $85, but in a matter of less than 24 hours, I made $215 on this trade. Now, one thing to note is the open interest and the volume when you're looking at these trades. Now, this is solely on the ask price. I didn't look at the bid price, and that was an error on my part. But this was just a virtual trade. It's just kind of showing you an example of how you can trade on implied volatility. Well, what happened was when I went to exit out of this trade, this is kind of a rookie mistake, but everybody learns from their mistakes. The open interest, which was 0, and then the volume was 0 as well. And it kind of explain to you what open interest is. Open interest would be buying a call. Okay, you buy the call, the open interest would be 1. And if you sold the call, then the open interest would be 0. So basically, open interest is showing you how many option contracts are open in the market, okay? And this isn't showing any of the contracts that have been sold, and it's not showing any contracts that have been exercised. Therefore, the other person in the trade will get the shares. So as a result, there was 0 open interest, and then there was no volume on this stock as well. And volume is different from open interest. The volume would be you buy one call and then you sell one call, and if that's in the same time period, that would be volume would be equal to 2. Whereas your open interest, if you bought and then sold, would be 0. So I didn't look at that until after I was about to exit out of the trade. And because that was 0, the market makers had such a widespread on the ask and the bid. And this created so much illiquidity that the trade was a loss no matter how much it gained. But overall, I am happy with the way that it played out, because this is just to show you an example of how implied volatility used correctly in your trades can create a substantial amount of profit. And again, so we had $215 that was made. That's profit, and at risk was $85. So the total reward overall and percentage, which would be, just doing the math here, it would be over 252% is how much profit you made, and that would be in less than 24 hours. So this would have been a great trade if there would have actually been open interest and volume for this particular stock. And again, you want to make sure that there is open interest and volume as well, because the more volume that you have, and this is true for just trading stocks and anything else, the higher the volume, it's going to decrease your bid-ask price, and that's what you want. You don't want a large bid and ask price, because for people who aren't aware, you buy at the ask, you sell at the bid, and that's where the market makers are making their money. So if there's no liquidity, then the bid-ask spread is going to stretch out, because it's going to cost the market maker more money if there's less liquidity in the markets. So again, this is a trade with TFS Financial Corporation. If you guys have any questions, you can drop me a comment, and you have a good day.